Welcome to FOMO Consulting for your daily AMC stock analysis video on Tuesday, May 18th. Ladies and gentlemen, the Hedgies are in full retreat and $14 is solid. We are beginning to own it. We have to hold it further and we'll explain why shortly. And as always, the apes are winning, the diamond hands are winning, and most importantly, the retail investor is winning. So if you find this video informative and entertaining, please like, share, comment, and certainly subscribe. It's a newer channel and I would appreciate the support. Let's get into the video. As always, I would like to thank everyone personally who has liked, shared, commented, and subscribed. Again, it means the absolute world to me. Thank you. Let's start with a quote. Experience is the teacher of all things by Julius Caesar. We are certainly going through experiences minute by minute, hour by hour, day to day, not only in our personal lives, but watching AMC stock and watching our opponent manipulate it, fight us tooth and nail to the bitter end, although we know we will conquer this opponent. So let's look at the broader market. Ended not very well. Dow Jones down 267 points, NASDAQ down 75 points, S&P down 35. We had a lot of positive momentum this morning. Earnings came out from several large retailers. Things were looking good, and then we got past lunch and there was some pretty heavy selling pressure. Obviously, as you can tell by the heat chart, tech took yet another hit, and as well as retail and other sectors. So we'll see what tomorrow brings, but overall AMC performed very well in the face of this heavy selling pressure. So let's look at AMC's daily action today. We closed at $14.03, up 8 cents or 0.57%. I think this was a perfect day. Again, we needed to cool off. We needed to let the moving average kind of come back to us. So we didn't overextend and correct. So this was a great day, up after hours just a bit. Overall, as you can see, AMC performed relatively similar to the broader market as shown below, but we held the $14 level. We were hit several times. We got down to $13.57, but we held it. We recovered. We spiked to $14.67 intraday, which was very promising, but most importantly, we closed above $14. That shows exceptional strength, especially going into tomorrow. So this is the hourly chart going back a couple of months. It's actually done quite well. As you can see, we are on a very, very bullish uptrend. Again, the alligator indicators you can certainly see are wide open. We have cooled off just a bit most recently, and I believe we needed to just to kind of recorrect and get back closer to the moving average. So let's look at the daily chart. So the daily candles, we are certainly on an uptrend since the baby squeeze in late January. The alligator indicators, as you can see, are certainly wide open. He's hungry and he's ready to eat. We are in a positive, very positive actually, MACD bullish crossover. We are looking very, very good. But as you can see by the illustrated red trend line, we have extended quite a ways off of our upward trend. So cooling off a couple of days will not hurt one bit. So let's look at the weekly. We are certainly on an uptrend and we have gapped up just a bit. And again, most importantly, I believe we just need to cool off just a little bit. Today was a great day, green, but not too awful crazy. So let's look at some fantastic news today. If you would like to read some humorous journalism. Horror movie, run away from AMC stock as if your life depended on it, by our friends at MarketWatch. So even better, AMC stock price is detached from reality and its CEO loves it. If you like satire and humoristic journalism, knock yourself out. So really important piece of legislation passed today. The ICE Clear Credit organization passed SRICC 2021-007. It's really around liquidity and making sure people do not overextend themselves, market makers, hedge funds, what have you. So again, it's yet another rule going into play just to protect the retail investor and protect the institutions of the banks. So there's been a lot of I guess conversation around, Citadel buying 750,000 shares. As you can see, these are the 13F filing listings, calls and puts. Obviously, the definition of hedging is long and short. So they are certainly setting themselves up for to try to limit their risk that they know they are certainly facing. But let's talk about what stock utilization is. So utilization is defined as loan shares divided by available shares in the securities lending market expressed as a percentage. So to get your day started tomorrow, let's crank up some tunes, right? Before the market opens, listen to Snoop Dogg's Money, 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 Money. Who doesn't like money, 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 right? So knock yourself out. Great music, great artist, wonderful song. So let's look at the Ortex data. So a lot has been made today about the utilization falling from around 100%, which we've been at for 2 to 3 weeks, down to 21.4%. Cost to borrow went down just a little bit. We're at 18.11%. The days to cover has gone down just a touch to 1.49. Shares on loan, we're basically at 142 million, gone down about 4 million or so, 5%. Free float on loan, we've gone down to 31.10. Estimated short interest percent of free float, 18.74. That's down just a little bit as well, all of which I believe are bullish signals, and I'll show you that on the chart shortly. One major change that's been ongoing for the last several days is the retail ownership. We are at 67.4%. We were trending for several weeks around the 80%, and that has changed specifically because institutions have been increasing their positions daily and substantially. They were in the 10 to 15% range. They are now at 25.4%. That is a huge increase, as evidenced by Citadel buying 750,000 shares, right? So we're at 415 institutional owners at this point. Again, certainly bullish, follow the smart money. Total volume was up versus yesterday, which is always good, by about 24 million to 170 million in volume. Short shares available at the time of this recording is 1.5 million, about as high as we've been in a long time in short bar fee, according to Fintel, 13.78 on their platform. So let's look at what this looks like. So I'm going to show you a few charts. This is GME. So what you really need to look at is obviously the yellow trend line. That is the utilization line. And if you look before the January squeeze, they were at 100% utilization. Squeeze happened, fell absolutely off a cliff, as you can see, but trended down. If you look at the right-hand side of the chart today, or actually yesterday, because all these charts are through end of day yesterday, they update 24-hour lag. You can see where GME fell off a cliff from a utilization standpoint. Let's move forward. This is costs. Popular stock, heavily shorted. You can see yesterday fell off a cliff. Rocket, heavily shorted. It's popped a couple times. Fell off a cliff. So here's a close look of AMC. You can see where utilization through yesterday absolutely fell off a cliff from around 100% down to 21%. Let's go forward. Even Tesla fell off a cliff over the last couple of days. They were around 15%. They are now at 5%. So we all know that AMC, GME, and others are tied up in quite a few ETFs. So this is the largest share owner of AMC stock. I believe it's around 8.8 million shares. It is iShares Russell 2000 ETF. Looks like a decent chart. So again, utilization fell off the cliff. So you can certainly see there's a correlation between all of these heavily shorted stocks. We have been under the assumption there's been a heavy shorting to the ETFs as well, and you can see utilization has fallen off the cliff. So again, let's come back to AMC. This is a longer term view, you can certainly see, but if you look at the red indicators I've put on the chart, every time before a squeeze or a pop in the price anyway, the indicators all fall off quickly. It did it in January, it did it again in mid-March, as you can see, and the price ran up. And now here we are falling off again, following that mid-March pattern. The utilization is huge, and as I've said for several days, they are running out of ammunition, they are running out of firepower, they do not have the shares to borrow, and no one wants to borrow them right now simply because it's too risky. So they're trying their best to return the shares, which is why the utilization is going down, because no one wants to take the risk right now. So let's take another look here. You can clearly see on the right side where the yellow arrows are, they are desperately trying to exit their positions, which is why the Ortex data is going down. The short interest trend lines are heading downwards. The yellow illustration trend line I have at the bottom shows the borrowed share volume. They are out of shares versus where they have historically been in the past. You can see how high those volume bars are and how thick and prevalent. They certainly do not have that. I do believe we are on the cusp of the squeeze. I believe these trend lines clearly show it, and I believe they are trying desperately to exit their positions. So let's look at what they were up to today. So as a market opened this morning, they returned about 1.33, borrowed 2.73, which is how they shorted it down. So as a borrow change of 1.39, they held. Around midday, they returned 3.22 million, borrowed 7.44 for a borrow change of nearly 6 million to their as the return. So let's look at end of day. They returned 22 million shares, borrowed an additional 13 million, which was a change of nearly 9 million shares. They are trying to get out of their positions, and no doubt that run up last night, scalpers, day traders, whoever, took profits, sold off their shares this morning pre-market or last night, and they took advantage of it. So I've shown this chart, the $14 level, $14.50. I've been talking about this for weeks. We've got to break the wall. We cannot go where we need to go. We cannot jump the wall. We have to break it, stand on its ruins, claim victory, then we can go forward to the moon. So huge, huge purchases today in the options. If you look, as I did my math, just in from 1,000 to 6,000, where I have the yellow arrows, that's around 29,000 contracts. That is huge. And if you look, they're all expiring May 28th, June 18th. Those are some really big numbers. No doubt this is certainly bullish. If you look, many of them are calls, and they are at $28 strikes. So again, I think this sets us up perfectly, and they know more than we do. So we're about 2.5 to 1 from a call to put ratio. That is certainly good. What I am going to be looking at very soon is if this swings the other way, if the puts start catching up or we become neutral, I will use that as a personal indicator that the squeeze may be on, simply because people are going to take a short position. They are going to place a heavy load on puts to ride the price back down. So let's look at the options chain. So the red trend lines I've drawn are the extremes, highs and lows I believe we can get this week. The yellow is the cautionary zone we could potentially go to, specifically towards the 15 range. If we close at 15.01 or better Friday, this will be an extraordinarily bullish signal. We will put a ton of contracts in the money on the call side. I believe the green zone is the true battlefield. I believe that 13 to 14 level, possibly 1450, is absolutely in play. They're going to do everything they can to keep those calls from expiring in the money on Friday. Most importantly, the next 48 hours, I believe, are crucial for a couple different reasons. If the price continues to go upwards, or if we stay 1450, the market makers tomorrow, possibly Thursday, will likely start buying shares to cover these contracts, because they pretty much have to. They are not going to wait till Friday, and most people will not wait till Friday to exercise their contracts. Secondly, the monthly contracts expire, indexes, ETFs, what have you, as well as the weeklies. So we could see some additional volatility over the next 48 hours. I am exceptionally bullish again on where we stand. If you just look at the open interest on the call side versus the put side, if we close above 14 or 1450 or 15, we are going to be in very, very bullish territory. And again, most of our recent squeezes happen pre-market, after hours, and middle of the week seems to be a preferred timeline. Fridays seem to be very rare, as well as Mondays. The middle of the week seems to be kind of the sweet spot for squeezes. So as always, I have skin in the game. Been a good run. 8 straight days of green makes up for 8 straight days of red that we had leading up to earnings, right? So I am perfectly happy, and I'm sure you are too, but we all want more. So I'm still of the belief we'll be in that 13 to 14. I did move this up to 1450. We'll see how the week progresses. Hopefully I am wrong on the low side and we go to the moon, right? Let's end with a quote. If you build it, they will come, from the movie Field of Dreams. I believe we have built this stock, we have built this movement, we have built this situation through buying, holding, and most importantly, commitment and dedication. We are committed to seeing this through. No amount of FUD, no amount of scare tactics or manipulation. We have been there, done that. We certainly have the t-shirt and all of the battle scars to prove it. We are not going anywhere. So as always, ladies and gentlemen, I want to thank you for watching. If you found it informative and entertaining, please like, share, comment, and certainly subscribe. It's a newer channel. I would appreciate the support. But as always, I hope your lives are full of green candles and you have a wonderful evening. I'll be in touch.